Mohnish Pabrai discusses the importance of finding just a couple of good investment ideas each year. He emphasizes the value of using curated sources like Value Investors Club to filter potential investments and reduce the data set to manageable levels, allowing for deeper, more focused research on a few high-quality opportunities.
If I can find two investments in a year that we can make, I think we're doing well. I think through the first 8 months of 2022, I found one investment and just recently a second one popped on the radar. I think this one will work. And so it's a good year. It's a wonderful year. And who knows what 2023 brings or what 2024 brings. It could be zero or it could be four. We don't know. So on the one hand, you have the 50,000 stocks. On the other hand, we only need a couple of ideas a year, maybe less. And so with that large a universe sifting through things and being, just asking basic questions like, is this within circle of competence? What is this worth? And that sort of thing. It will get rid of a lot of companies. And we can use hacks to reduce the data set. One hack you could use is, for example, if you limit yourself to only buying businesses that have a write up on Value Investors Club, for example, because that's a very well curated site. It's difficult to become a member. You have to keep submitting a couple of ideas a year that are decent to keep your membership, etc. So the average idea on Value Investors Club is better than throwing darts at a board and picking an average stock to research. So if you use the Value Investors Club as a starting point to doing research, it trims down the data set quite a bit. And the write ups are pretty good. So if you just went through and just read the write ups and then just left with the ones that you think are businesses you understand or thesis that you agree with, then that becomes a basis to do more work and see if any of those can jive with you. So that can be a good source. Data Roma, which gives the 13F filings or a bunch of great registers, that can be another great source. Barron's could be a source. There's a number of sources you could use. Through that mix of things, trim them down. I made my first trip to Turkey in 2018 because the currency was very unstable. Everyone and their brother was leaving the country en masse, and the markets optically looked really cheap. So I had a good friend in Turkey, and I just said, listen, can we just go and visit every business in your portfolio? I didn't want to visit every listed company in Turkey. I wanted to visit the ones that had already gone through his filter. He had actually put money into it and so on. And that was a great trip. Found a few things that look interesting. And then the following year, I made another visit in 2019. That's when we visited Resas, 3% liquidation value and so on. So I think that there can be a number of different ways in which you can create the research list, if you will. Could be Value Investors Club, other publications, and Barron's, Roma, or might say, okay, particular geography might hold some promise, and let me dig further and so on. So there can be a number of different ways in which things can enter the funnel, since the output from the funnel should ideally be pretty small, because I think most of us probably cannot find more than 2, 3, 4 things that make sense. And that's a good way to go. A lot of my energy is focused on one particular company, right, that I'm drilling down on. At the same time, I'm reading several newspapers every day. Value Line shows up once a week, and my assistant gives me a PDF of, like, for example, all the ideas posted Value Investors Club in the last month or something, and so it's a mix. I would say that at this point, probably 80-90% of available horsepower is being directed to one business. And I'm still looking at a bunch of other things. Most of those get discarded pretty quickly. If something shows up on the radar that looks interesting, then I will relatively quickly try to figure out which of the two businesses I now have are the ones, which of the two should be given more priority. And then we take it from there. Basically, to try to do a comparison, try to see which one risk adjusted is a better bet. And so, Charlie had told me a long time ago, almost like within the first or second meeting I had with him in 2009, he told me, Monish, it's really important to have someone to talk to about your investments. So I told him, oh, you mean like Warren Buffett? So he said, well, it wasn't always Warren, but I've always had someone to talk to. I actually incorporated that. I hadn't thought about it that way till then. And I made a deliberate attempt after that to seek out other opinions. Sometimes people who the company, sometimes people differing opinion on the company and such. Yeah, I mean, John Templeton says that the best of us will be wrong one out of three times. So if I make 6 bets in 3 years, even though I'm making 2 bets a year, according to John, 2 out of those 6 bets at least might be, that's a minimum. It would be actually 3 out of the 6 bets. Don't do what you expect them to do. They do far worse than what you expect them to do. Now, my hope is you don't have permanent loss of capital, that if it doesn't work, you get your money back or something. But many times you're not that lucky, so you may suffer some loss of capital as well. And so that's just par for the course. Even when I look at Warren Buffett's investments, and if you were to look at like his, let's say, 70 or 80 acquisitions that he's did at Berkshire, easily more than a third of those have not worked. So, and this is Warren Buffett with Charlie Munger, with a lot of, the best of the best. And the good news at Warren has been that the larger ones in general have worked. And so if you dollar weight it, he's had a very high success rate. But if you equal weight every one of those 70 bets, it would be a terrible record relative to what we've seen with Berkshire Hathaway. Like they made a large number of investment in furniture retailers. I think every single one of them except Nebraska Furniture Mart never worked. Lots of investments in jewelry retailers. And every single one except Borsheim's did not work. In fact, most of those businesses during the financial crisis would have just gone under. I think they only stayed alive because they had the support of the parent. So they would have basically been zero in the number of cases. I think that, yeah, it's important. Anything that you can do to bring the error rate down. So talking to other people who don't have any biases or, a reason to agree with you and such, and are more objective, and that can be a great asset. A business that is within your circle of competence, the moat will be very apparent to you when you just think about the business. And then it would get ratified when you look at the numbers. So generally speaking, a great business is going to be generating high returns on equity without much use of leverage over a long period of time. So that's going to give you the proof of the pudding, if you will. But I think before that, so for example, even before I look at the numbers for Starbucks, I know it's a great business. I mean, I know for a fact that when they open a store in the US, they get all their money back in 2 years. So Starbucks doesn't franchise at all. It's all company-owned stores, except the ones at the airport, so they don't have a choice. When they open stores overseas, like in China, etc., they get their money back much faster, like 15 to 18 months. So the payback is even faster. I mean, that is a business that is generating something like 36% unlevered return on equity with a massive run ahead. If you just think about the number of Starbucks stores that might exist in the world eventually, and at which point they kind of stop growing or grow very little, that day could be pretty far away. They have a huge runway. They've already done so much for so many decades, still keep ranking. When you look at a business like that, and, we encounter Starbucks because we customers, and a lot of moats should be apparent to you. So, first of all, if you just looked at all the products and services that you as an individual consume, you would be surprised how many of them have deep moats. Because, in general, for a random business to convince you that they deserve a share of your wallet is a pretty high bar. We all tend to want to get good value and, you know, products or services that enhance our lives. And especially if we have deep loyalty towards those brands and such. So, the brand of razor you use, the brand of shaving cream you use, the brand of toothpaste you use, the time you wake up, your soap, your shampoo, your breakfast brands, and, the clothes you're buying, and, the cars you buy. It just goes on and on. We encounter a lot of brands, and we are using a lot of brands and a lot of products and services. And when I bought my home, the insurance company required me to have kind of a alarm service like ADT before they would write the policy. And, ADT has a moat. Other companies are requesting me to, get their service. If you are a corporation issuing a bond, you can't get it out unless you're rated by Moody's and S&P. And Moody's and S&P have a moat because it's written into the covenants and such, and so on. So I think that knowing what is a great business is not a difficult exercise. Then the next piece, which is it a great investment? That's a much more difficult.
Pabrai concludes by highlighting the necessity of distinguishing great businesses from great investments. While identifying businesses with strong moats and high returns on equity is straightforward, determining if they are good investments at current prices is more challenging. He stresses the importance of patience, thorough research, and seeking objective opinions to improve investment decisions.